people need to understand how a bank works. It's a classic Jimmy Stewart problem. When you put a deposit in a bank, they don't lock it up in a safe. They keep a lot in reserve to make sure they have enough liquidity, cash for deposit withdrawals. But most of it, they make loans, they make investments, and whatever returns they make on that, that's how they get their profit. And then they pay some of that in interest to the depositors. That's how it works. If you rush into a bank, everybody at once, this is what happened with Silicon Valley, and pull all your money out, you're going to force an otherwise healthy bank to fail. And that could be a very, very serious problem for our financial system. So that is really the dynamic the regulators have to avoid at all costs.
And if you look at the balance sheets of the banks, virtually none of them are sitting on enough cash to back demand deposits that can be withdrawn at the speed of minutes now. So here's the thing. It used to be you had to go to a bank branch and fill out a paper form to make a bank withdrawal. Now you can do it on your phone. What's interesting is that the bank regulators have for a long time hated the most tech forward banks. They like the concept that everything has to be analog because it slows everything down. Just yesterday, the Fed confirmed that FedNow, which is the new payment system that is ultimately going to replace FedWire, is coming online in July. And it's a 24/7, 365 system. And there was a lot of information in the press release about the testing requirements that the banks that are going to be rolling it out in July will have to comply with. There was zero acknowledgement that the speed of money movement is going to increase inherently when you get a real-time system. So we were talking about how long it takes for you to put the payment instruction in, analog versus online banking or API. But now there's also speed up of settlement once the instruction is received by the bank. And that is going to be real time. Now, FedNow only limits you to $100,000 at a time, but $100,000 at a time equals increased bank run risk inherently. And I was floored that the Fed said nothing in that press release about requiring the banks that are going to be offering FedNow to hold more liquidity. It means they don't get it yet.
You did tell Politico that there was no doubt in your mind that there would be more bank collapses. It's been an eventful week. Do you still think that is the case?
Oh, there already has been.
Right.
So
do you think there'll be more do you think there'll be more from here?
Yes.
But I think it's pretty clear there has been a decision across the bank regulatory agencies in this administration that crypto is inherently risky and needs to be extricated from the banking system. My personal view is, if you treated crypto as a normal yet high risk legal activity, you would have crypto distributed across a large number of banks. No one bank would be the central failure node for the economy, and this would all be managed much like other risky things are managed, like derivatives, like, high volatility assets and other kinds of things. But because this was seen as a niche business and a super, anathema business, it was concentrated in 2 or 3 banks, and those 2 or 3 banks have now largely been taken out. Well, 100%. I hate to burst your bubble, but yes, the way the bank regulators work is that they are highly coordinated. I mean, when I was running the OCC, I had a weekly call with the FDIC chairman and with the vice chairman of the Fed for bank supervision. We talked every week for an hour and talked about what our priorities were for the coming week, how we could support each other, how our actions would affect the system. So these things are not accidents at all. I'm highly confident of that. And honestly, if you look at the SVB situation or the post-SVB situation, it's interesting because it is a coordination between the Fed and the FDIC. The Fed has created this new liquidity facility, which is broadly available to a number of banks, and then the FDIC is running this process to save the SVB depositors as an example of how these agencies work together. So you're right, of course, there was a failure of risk management at Silicon Valley Bank. They, for example, had an ESG committee, but they didn't have a chief risk officer for 9 months. But the other thing you have to remember is the reason that we have bank supervision is to be an early warning sign of those kinds of failures. So who supervised SVB? Well, the answer is the Federal Reserve. And who was raising interest rates? Again, the answer is the Federal Reserve. I mean, if you think about the way that bank policy gets made, it generally starts either in the White House or at the Senate Banking Committee, okay? And so the senior clear-most Democrats on the Senate Banking Committee, Senator Brown of Ohio and Senator Warren of Massachusetts, have been very, very publicly anti-crypto for a bunch of reasons that I've talked about extensively elsewhere. One of them is crypto is user-controlled finance, and this is a crowd that believes in government-controlled finance. They've talked extensively about Fed accounts, about postal banking, and a whole series of other things that would imply a much greater degree of government control that crypto is consistent with. Now, they mask that under sort of the guise of consumer protection. You know, we're very worried about all of these, you know, unsophisticated rubes who are buying Bitcoin. But in a world where 50 million Americans own Bitcoin, I don't think that argument washes anymore. It's too widely held of an asset, and it's too important of an asset in people's portfolios. So the only answer I can come up with is they have a view of government-controlled finance, and others have a view of user-controlled finance. One of those sides has to win, and they're not compatible with each other. Yeah, I mean, look, my guess is that when you have demand that is as strong as it is, there will always be smaller banks that are willing to step up and try to risk manage this. So, you know, you get rid of Signature Bank and you have Customers Bank, and you get rid of Customers Bank and then you have Coastal Com. I mean, there's always somebody who's going to serve this because there's a demand, and crypto's not unlawful. The question then becomes, you know, how quickly and how committedly is the administration going to go after every single last one of those, and how will they answer to the 50 million customers who are looking for fiat on and off ramps? My belief is that they're trying to send a signal that will eventually choke this off. That's again what Operation Choke Point was. But you can't kill all of the animals in the zoo at some point. So my belief is there will always be somebody serving it. It would be better if larger banks with better risk management were serving the sector. But if they don't, there will be somebody doing that. And hopefully over time, as the asset class matures, you know, people will get comfortable with that.
From Secretary Yellen. I just want to start. Do you know how much a dollar that you held at the start of the Biden administration in January 2021 is worth today?
Well, we've had inflation and it's declined in its purchasing power.
It's worth 87 cents. In your testimony, you said that inflation is the #1 economic problem. Do you know what the inflation rate was at the start of the Biden administration in January 2021?
It was substantially lower.
It was 1.4%. You said that inflation has many causes. I agree with that. By the way, I would say that the #1 economic problem is our debt and deficit. And I would say that the top 3 causes of inflation are massive deficit spending, the war on fossil fuels, which have driven gasoline prices to record levels, obviously supply chain dislocation. That was caused by our miserably failed and incredibly stupid response to COVID, the pandemic. But would you agree those are the top 3 causes of inflation? Deficit spending, high energy costs, and supply dislocations?
I don't believe that deficit spending is one of the main causes of inflation.
I mean, inflation is too many dollars chasing too few goods. Well, so when you're printing all this stuff, so do you know in the first 3 fiscal years of the Biden administration, you know how much the total deficit spending is going to be?
We had an economic collapse that was caused by
right,
the
and we
pandemic.
were certainly coming out of that because there's all this pent-up demand and a sloshing around of trillions of dollars. So I'll answer that question for you too. The first 3 fiscal years of this administration, the total deficits would be about $5.7 trillion. So now you're here testifying about the president's budget. How much are the total deficits over that 10-year period according to the president's budget? You don't know that off the top of your head? Yeah, I'm running out. It's $17 trillion, okay?
Yeah, that's
you're going to drive the debt from somewhere around $32 trillion up to about $50 trillion, correct?
Yes, but what I believe is the single most important metric for judging the fiscal stance of the country is real net interest as a share of GDP.
Okay.
We have
so are you concerned when
GDP.
you're taking the debt from $32 to $50 trillion? Are you concerned who's going to buy that debt, and also at what rate they'll expect to be compensated for buying riskier and riskier debt? Are you concerned about that?
Well, if the real net interest cost of the debt remains low relative to GDP and we're on a sustainable fiscal.
Well, we're not on a
Well,
sustainable path.
I would disagree
Senator
with that.
Senator Cassidy was talking about the president's demagoguery on Social Security, unwillingness to meet to try and save Social Security. If we do nothing, and the Social Security Trust Fund runs out 2023 to 2025, about the end of the budget period, are you concerned about, are we going to have the financial wherewithal to plus up benefits to honor those promises? I mean, you think we're going to, with $50 trillion in debt, a debt's exceeding our GDP, aren't you concerned about our inability to honor those promises?
The interest cost on the debt as a share of our economy remains quite low throughout the 10-year horizon of the president's budget. It remains around 1%.
Secretary, and you're also the one who said that
very manageable.
You also said that inflation was transitory, and it certainly isn't. And I think Chairman Powell certainly now agrees the fact that, no, we've got something going on here that's going to take a very long while, unfortunately, to wring out of our system.